Wilkinson. You may recognize Eric the Wolfman Wilkinson from numerous financial networks. He's an educator at ProTraderStrategies.com. He's sought out by several media outlets to debate against some of the brightest minds in the industry. He is most notable for his comments in Rick Santelli's Rant Heard Around the World, when he was the first to use the phrase, what is it, Eric? Moral hazard.
Right. It's starting to come back around again, right?
I'm afraid it may. Let's not see what we did in 2008. But Riley, if you will, we'll let Eric start setting the screen and you can tell us what Eric's going to present on today.
Sure, absolutely. Well, Eric today is going to be talking about the covered call strategy. It's one of his favorite strategies, and he's going to talk about why understanding why options pricing is key to any strategy, understanding the pricing, how to avoid buying and selling option premiums at the extremes, and simple steps, showing the right time to buy and to sell options. And so with that, we are welcoming Eric to the room. Wolfman, how are you doing this afternoon?
I'm doing well, Rolly, and great to see you too again, Pat.
Thank you.
Thank you.
All right, so share a screen, right?
Yep, if you grab share screen.
All right, I think we can see my cursor moving around, right?
Oh, yes, looks great.
Perfect.
Been going. All yours.
All right, I guess I lost all the questions in the chat window off this, but
we'll feed those to you, so no
all
worries.
right, yeah, and feel free to blurt it out there at any time. I want to make sure everybody's clear of concept before we get moving on to the next concept or anything along that lines. But again, I want to thank you guys all for having me a part of this March Market Madness. I've got some great stuff, and I'm actually in line with Matt Buckley. Both of us floor traders have seen this and kind of get this gut feeling around this. I just talked about this in my daily market commentary today. Anytime we've seen this massive rally that we've just incurred over the last year, we usually have a time of consolidation, maybe some correction. I don't know if we're going to see a 20% correction necessarily, but if taxes start rising, we might. So with that being said, a lot of people have gains in their portfolio that they can start becoming more mechanical with. And what I mean by that is whenever we are long stock in a portfolio, I encourage people to do covered call strategies. And why do we do that? It lowers our overall cost basis. Similar to what Matt Buckley was talking about as well, is it also keeps you mechanical. It keeps you focused on that underlying, and you can do this strategy even if you're working outside the home. Stay-at-home traders obviously are doing very well, or people working from home seem to be trading a lot these days. But having said that, you can put these covered call strategies on and just leave them. It helps you keep your powder dry if we are to have that correction. You're not as concerned about a little bit of a market correction in this underlying you have, because you're making money on those covered calls then. So it's kind of that win-win. You don't mind that pullback. Sometimes you actually are looking forward to it. Hey, let's get a little bit of pullback. Let me get out of these covered calls, lower that overall cost basis. But a couple of things with me real quick, just to get out of the way. I worked on the floor of the Chicago Board of Trade. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products. I actually started out trading options in college around this specific underlying, and Walmart was another one. But IBM, I used to trade covered calls in IBM at around 110. Where is it trading right now? Right around 128, 130, okay? So it hasn't really gone anywhere in the last 20 years. Can you imagine how much you could have lowered your overall cost basis on a trade like this? Well, it has gone up into the 170s, but for the most part, it has reached or stayed in a range-bound area. So a stock like IBM, even Amazon these days, where it's kind of gotten into a range, is a great underlying that you can easily get into trading covered calls. And the reason why I like this covered call strategy is because it also gets us a little bit more comfortable with selling options, which is considered to be more risky. And when we're selling options, it means that you are collecting a premium. You have the obligation to sell the underlying at that level, wherever your strike is. Well, in an underlying like this, if we were to pick something in and around that 130 level, you can see that you could have done very well consistently going out there and selling calls, you know, in and around this 130. So up here, and then you just, what we aren't going to talk about necessarily today is sell some cash secured puts down at around this level, get that back and continuously do that cycle. But I want to talk about the cash or the covered calls right now to lower overall cost basis. Most people look at an underlying like what we have here with IBM and see it trade in a range right here and can immediately understand the value in doing a covered call strategy. You put these on lower overall cost basis and then move on. Well, I'm going to talk about different examples where we can see something that is moving in a very parabolic almost fashion and still do a covered call strategy around that underlying successfully. But let's talk about a couple of things with the Greeks. Yes, don't please run away right now. I am going to talk about the Greeks, but I want to talk about them from a perspective of what we'll be looking at more often than not with these Greeks. And on the floor, we used to say that delta is just data. It gives us all kinds of things. Yes, it tells us how our options premiums are going to be affected by that underlying. But mostly what I want us to consider today is that delta is data. And really what that's coming out to is it's the probabilities. All right. It's our probability of being in the money. Okay. And we want to obviously have a small probability of our short call being in the money. And when we're looking at a standard deviation curve, and all standard deviation curves look different. Some of them will look like this, where they're a little bit skewed to the put side. Some will or have a skew like that. There are all kinds of different skews in this, but I want to specifically talk about just standard deviations, because even as volatility shuffles around, these deltas tell us the probability of our option being in the money at expiration. Okay. So that is key. And when we're looking at a standard deviation curve like this, what I like to focus in on is right around that 16 delta. That is really the sweet spot. And folks, covered call strategies really work better with stocks that are over $50. It's really hard to do a covered call strategy on a stock that's trading in the teens. Your risk reward, the amount of money you're going to collect for a covered call on a stock that small or pricing that small, you're going to be really tight to where that underlying is. So it doesn't work out as often as some of these bigger price stocks. The volatility is more robust. There's more people in there trading those options. That's another thing. You want a lot of eyeballs on this underlying. So you want a lot of people trading, a lot of open interest in this underlying. 16 delta means that there's only a 16% probability of being in the money. That means the underlying only has a 16% chance of being above that one standard deviation. And the way that they come up with that percent is if you add up the 9.2, the 4.4, the 1.7, the 0.5, the 0.1, the 0.1, and blah, 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 all the way out. That will add up very close to the 16 delta. And that is where we are talking about being a one standard deviation move. Also, that means that this is an 84% probability of happening during that life of that option. So an 84% chance of the underlying being below where we are with our strike location at expiration is key. So very concerned with looking for this 16 delta. It gives you the best bang for your buck as far as I'm concerned. Yes, you could go into about the half standard deviation. If you were really concerned, like our last speaker was talking about the concerns of this market correction being 20% or more, well, maybe you would get a little bit more aggressive and go to that 36 delta. That is a very aggressive covered call strategy, folks. Another thing we used to say on the floor, not only is this a 36% chance of being in the money, yeah, 64% chance out of the money, pretty good probability still, but keep in mind, two times delta is our probability of being touched. All right, it's your probability of touch. That means during the life of this option, there is 2 times that delta that the underlying will come up and kiss your strike. Okay. So we need to know those probabilities. Why? Because it's still a pretty low probability of that even happening with that 16 delta, right? Only a 32% chance of even the underlying coming up and just, making me a little bit nervous. So knowing the probabilities is probably a little bit more important at this juncture than knowing how the underlying is going to be affected by the delta, right? If the underlying moves up by 1, my premiums are going to go up by 16 cents. All right. That isn't as important to me in keeping my powder dry or staying mechanical with this underlying, taking the fear factor out of it. If I know my chances of all of these things happening, chances of my strike being in the money is 16%. Chances of my strike being touched or kissed, 32%. Pretty low probabilities. If you go to that 36 delta, you've got almost a 70% chance that the underlying is going to be tested. All right. So I like to stay away from that, especially for newer traders. I encourage you to go out to that 16 delta until you start getting a little bit more comfortable with this strategy. Then yeah, absolutely. Start getting a little bit nervous about a top. Maybe you see a swing type trade where it might start rolling over. That would be where you would get maybe a little bit more aggressive. But ultimately for me, the sweet spot is just standard. Go at that 16 delta. That's probably going to give you the best bang for the buck. Now, theta is also one we're going to need to know about. Why? Because it's the thief in the night that comes and steals your premiums, folks. Every single night, this theta comes in and takes premiums from the people who bought options and from the people who sold. They're actually looking forward to that thief coming up and kind of nibbling away at your pocket, taking those premiums, right? Because then you sell high and buy low. And with this covered call strategy, even if the underlying doesn't move at all, we could see our position increase in value because of those covered calls losing value. If those covered calls lose value, that means that we sold high and could then buy back in low. So we want the thief in the night to come and steal our premiums because it will eventually take all of that time and erode our premiums to zero. So this is a pretty good representation showing that theta is not linear, folks. It starts really ramping up, especially inside of 35 days to expiration. This is going to be the covered call area, all right? So this is where we're going to be looking for our covered calls inside this 35 days to expiration. Why? Because that's when this thief is most aggressive. We want to take advantage of that, right? We're selling a call. That theta isn't affecting our underlying whatsoever. So that underlying could never change in price, and this covered call strategy would work out because of this theta component. So we want to get as close to 35 days to expiration as we can. Sometimes we're just inside of that, folks. Sometimes you're out in or around 40, 45 days to expiration. That is as close to 35 days to expiration as we're trying to get. All right. So sometimes, yes, you will have to be looking out a little bit further, but you can still see this. We're trying to get involved in a situation where this theta really starts picking up. So our premiums versus that theta is going to be best inside of 35 days to expiration. Out here, this is where you want to be thinking that you're buying options, all right? This is where we start thinking we need to sell options inside of that because we can take advantage of all of that theta decay coming out. Now, if we look at the option montage, and let's just say this is for XYZ, it doesn't matter what stock, they all have their own theta component for the puts and the theta component for the calls. You can see that theta is always negative. That's because you can't go back in time, folks. We don't have a DeLorean to take us back in time, so we can't get back that money. So every single night you can see closer to expiration, theta is much more aggressive than just outside of 30 some odd days to expiration. But it will start picking up. Tomorrow, this might be 6 cents out of these. Every single night, that theta component is going to start ramping up. And we can see, 90 plus days, that theta component isn't as aggressive. So when we're selling premiums, we want to take advantage of theta decay, okay? And which is why I want to get involved a little bit early, take advantage of that 50% reduction in our premium. So basically saying from 35 days to expiration to 7 days to expiration, we only in that 28 days, we get a 50% drop, right? 50% of our premiums lose value. Now you might be saying, hey, well, you look at all the theta coming out with only a couple of days. Why wouldn't we do that? Well, folks, you're going to be selling, basically really close to where the underlying is trading. You're going to have a high probability, 50 cents, to be able to get clipped on that short call. Whereas if we were to go out here, I'm able to get out here into one of these two options, 135. So basically putting me $7 higher on this particular example here. So we want to get right around that 35 days to expiration. That's going to be our wheelhouse for selling covered call strategies. And you'll be able to find something for sure in and around that. So like I said, this is what we're looking at. Covered call, you could easily sell it. I got up here and around this area. That's where I would want to be selling some covered calls. You'd want to sell covered calls up here when it goes up and gets near that 130 area. Obviously, if the market started correcting back down, this would be where you would be buying back your calls, okay? So I like to say, sell the rip and buy the dip. And folks, in my humble opinion, this is one of the best stocks to start learning to trade, selling covered calls around. So if you have IBM in your portfolio, that's a great one. You can look at it as every time I sell a covered call, I've lowered what I paid for this underlying. You could also think about it if you're just looking at an income stream strategy. You're also getting a nice dividend with IBM, right? And then on top of that, I'm getting an extra pay from selling covered calls every single time I see that market rally. So you're collecting another dollar. And remember, a dollar is equivalent to 100 of the underlying. So basically collecting another $100. So for every $100, you're going to get a nice dividend and that extra covered call. But with that said, folks, you are going to have to stay very involved in and around this underlying. It doesn't mean that you have to watch it all day long. What I'm just saying is that you want to come in, do the covered calls, put in a couple of bids, maybe they're GTCs, keep an eye on them to get out of those. I always like to put my GTCs on a covered call strategy in around 10 cents. Just get in below a dime, folks, because at that point in time, you're just trying to squeeze water from a rock. It's going to take a long time for that last nickel to come out. I'd rather cover it for a nickel. The market gets a bit of a pop during that time. I can sell even maybe that same strike for a little bit more again. So I like to stay mechanical with it. Put this covered call strategy on, put in a GTC to get out of these at around 10 cents would be what I would do if I wasn't able to watch it. And like I said, you're going to be very involved in this. Look at all these trades that I've put on. Not all of them are filled, right? I've got some cancel orders in there where I'm just staying mechanical, trying to get out for some profits. Got my, buy it for 10 cents. 4 days later, I ended up getting them for that 10 cents. But staying mechanical with it, trying to get out, trying to get out for that nickel. But you can see ultimately it all ends up just being about 12 trades in total. So for this IBM, let's go through it. We can see that I got involved with this strategy on earnings, and I went in and sold the 120 puts for earnings, collected a 57-cent credit for that. Remember, option contract multiplier times 100 because it's equivalent of the 100 of that underlying. 57 cents is $57. So I collected 57 for that trade. The market just fell out of bed on that earnings. They actually beat on earnings, and I should know this from trading IBM for 25 years. The Wall Street traders hate IBM's earnings, no matter how good they are. It's because, especially in the last several years, they've been talking about moving away from being a service company into being a cloud-based company. Well, service sector of their company has very low margins. That cloud has huge margins. They're putting a lot of money into that cloud for future benefit. And it always kind of makes their earnings look a little bit fuzzy to some people. But anyway, so with that said, I liked being long IBM. It hit 120. I'm getting put that stock. All right. So these are weeklies that expired. I knew that stock was coming into my portfolio. I immediately got aggressive with this, started selling the 105 puts. Now, one thing I would always suggest is you never do options and try and leverage yourself out, folks. If you're used to buying 100 of the underlying, stick with one option contract equivalent to the 100 of that underlying, because if something like this happens where you get put that stock, you need to have that money in order to buy it. All right. So with that said, this would have probably put me a little bit heavy in IBM if I had gotten the 105 puts along with being long at 120, but I was more than comfortable with that, especially with a nice earnings that they had. I was willing to go in there and get aggressive, start selling for dollar cost averaging, collected another dollar here on these 105 puts. Now, volatility actually started really spiking. So I had an opportunity to sell some calls against my long stock. So remember, I'm long at 120. I sold 105 puts in case I do some dollar cost averaging. And then just based on what I was already long, I sold some 120 calls in there to have my long stock called away. Now, I haven't been put that stock yet at 105, so I didn't have to worry about that. I haven't tried to do a cover on that. Well, obviously, market starts rebounding. I was able to get out of both my my short puts and my short covered calls for this strategy, lowered my overall cost basis by now another $1.85, right? Because I bought back here. Plus I originally kept this 57 cents. I just sell the rips, right? So we get a pop up here near this 125. I'm selling the 129s because I'd be happy to get called away at 130. That's kind of the sweet spot for me. Was able to get it back. Market didn't go anywhere. Able to buy back the 129s, sold the 135s. Market didn't go anywhere. Got back into those. Market actually went through a cycle to sell off, staying mechanical, sold the 125s, didn't go anywhere, didn't really go anywhere. And then these 130s, this was the latest trade that I had to deal with. So overall, with this entire time, all the way to here, I have lowered my overall cost basis in this trade by $4.88. That's $488 extra from doing these covered calls. Now, we showed you got a dividend during this time also. It didn't add up to this covered call strategy, folks. And I, remember, lowered my overall cost basis by $4.88. Now, it doesn't look so bad. I bought it at 120. I've lowered my overall cost base by almost $5. All right. So I'm getting my break even right here. Now, my break even is way down here at this level. All right. So I continuously roll those out in time. So what happens during this trade is we can see that I'm going to have to start looking at this relatively soon because what happened here is I went into expiration. Remember, I'm short the 130 calls in here heading into this final day. Well, Friday, the market peeled back out. So I got below my short strike on these short covered calls and they expired worthless. Believe me, I had to wait into the end of the last day. I was willing to have it called away from me at 130. If it were to happen, I would have immediately flipped my agenda to selling cash secured puts in this strategy somewhere around this 115 area. That didn't happen. Market fell out of bed. These expired worthless. So I got to keep this 54-cent credit, lowering my overall cost basis. What am I supposed to do now? I'm looking for an opportunity to get back involved in this strategy with selling some covered calls here again. So if we were to look at IBM, excuse me, of course, I'm going to be looking at as close to 35 days to expiration. So that gives me between the May and the April. Well, I would say that this is probably closer to 35 days to expiration. I'm still inside that wheelhouse of theta starting to ramp up. 4 cents here, if I go out in time here, it's going to be about 2 or 3 cents in respect. So I'm getting an extra penny or $1 a night taken out of these premiums, which I'm more than happy to take advantage of. With that said, I'm going to be looking somewhere between this 60, right around this 16 delta. I might default a little bit closer just to get a little bit more, but this 16 delta looks pretty good. So I could collect another 50 cents if I'm to sell some calls against this, which I'm going to probably do in the next day or so. I'd like to get maybe a little bit more follow through to the upside, get some good location on a swing, maybe see some topping pattern here. That's when I'm going to start jumping into this covered call. Sell the rip. I've got a rip going on here in IBM, as we saw in the charts. And if I do this with this IBM trade, we can see if I pull up my other platform, let me try and find this let me just pull up a chart of IBM here. Because what we can see here is this 136 as a Fibonacci. This is going way back, but you can see I've got it lined up right around 136. So if I sell that 137 strike, that's another thing I'm going to be looking for, is get above a couple of Fibonacci's. I like to do that as well, and get a little bit more pop, maybe even see a confirmation of a correction tomorrow. But I am ready and waiting to continue to lower my overall cost basis with this trade by rolling these calls out again and selling them up. Now, I don't always, folks, do this rolling covered call strategy where people will say, get out of your covered calls, roll them out in time and higher. I like to sell calls on the rip. We get a bit of a pullback. I cover my short calls, and then I wait for another rip. Do some covered calls then. I'm not immediately just jumping and rolling these out in time every single time. I will take a breather, let it breathe, and wait for the market to move in my direction a little bit there. All right. And Pat, I forgot what time I'm supposed to go till. So, just yell at me if I start breathing.
You got another 30 minutes, Eric. So we're in good
plenty
shape.
of time.
Yeah, absolutely.
A couple of examples we can go over. So obviously, I've lowered my overall cost base by almost $5 on this trade. I'm going to look to get into another location where I can sell up here at around 137 at this time. So any type of pullback, it's going to be a time where I'm going to immediately fire into this. Now, we showed you an example where this underlying, like we said, during the life of this contract that we've traded, hasn't really gone anywhere, causing us any angst whatsoever. We've done very well on an example that is easy. But what would you do on a stock like, say, for instance, Penn, where it's gone from $4 and a basic parabolic move most would consider, all the way up to 142, and this is almost exactly 1 year away. All right, went from $4 stock, folks, to $140 stock. Most people would say you cannot do a covered call strategy against this. Well, if we are following the way that I teach, using the 16 delta, selling on these rips, buying it back on these dips, not just necessarily rolling this out in time, because that's much more difficult to really get good strike location. Picking your opportunities, you could do a covered call strategy in this, and I did, folks. I actually bought the stock on this day where it hit the low on March 18th. Hypothetically, folks, we are always talking hypothetical trades here. So had we hypothetically bought this trade or bought this underlying at 449, we could have done a covered call strategy. Now, I said you can't really do covered call strategies when it's below $50. Well, you'll notice I didn't start doing my covered call strategy until it got above that $50. So here was the first time I started looking at doing covered calls. And on this specific day, why did I do it? Well, it looked like I got a bit of a high candle there at the top of a move, right? It is a spinning top doji, hammer doji, whatever specific doji that is. I know that's a topping pattern doji. How's that? I know enough to be dangerous. and therefore would be a nice time to do a swing type trade. So I sold the 85 calls in October, and I was able to collect $1.36. Well, I bought it at $4.49, collect $1.36. You can do the math pretty easily. I've lowered my overall cost basis, right? Well, the underlying trade sideways, I got back out of those for 14 cents. So lowered my overall cost basis by $1.22 because I have to subtract that back out what I paid, right? Ultimately, it's that $1.22 right here that lowered my overall cost basis on it. And I didn't immediately roll those, did I? Market stalled off. Well, I wasn't going to start chasing that market when it's selling off. I'm going to wait for the rips. And you can see that I waited for a bit of a rally here and decided to get back involved in selling the covered calls. So I did it again for another $1.02. Well, what happened when I sold these puts? Well, the market continued to move higher. Yes, and I got another rip above where I was doing it. Started getting nervous, to be quite honest here, and I covered them. I just said, you know what? I'm not going to have this called away from me. I've got a little bit of a profit here. I'll just take my 25 cents and let this play out because the market's really getting, I mean, you don't even need to be a chartist to see that this market is starting to want to rip to the upside. So I got out of those. But just a couple of days later, after that, getting out of those DS90 calls, I went out in time and higher on the strike. All right. So I basically went out and increased that spread. Now I'm at the 120 calls in January. Where do we do here? And sold these January 120 calls for another $1.23. So lowering the overall cost basis. I bought those back right here for 23 cents. So I made another $1. All right. So you guys can do I'm almost at $2.50, lowering that overall cost basis, half what I originally paid for that underlying. Again, going into the 140 calls, selling those for another $1.93. Yes, there are points and times where I do a roll. I rolled the 40s out to the 165. So yes, I will do an actual roll every now and again. And I was able to collect another $1 for this. All right. So I collected $1 total, right? Got out of those for 20 cents. You could look at it as collecting 73 cents, however you want to look at it. Anyway, so I rolled those out. I'm covered calls on the 165s. Now, on this specific day, you can see I got a little jiggy with it. I covered the 165 calls in this trade for 17 cents. All right, lowering the overall cost basis. I got out of that. Now I've lowered my overall cost basis on this trade at this given time before I start really getting jiggy with it to about $4.25, $4.20 ish, right around there. So almost own this stock for free. Well, I got in there and I sold these 170 calls on the same day, sold the 170 calls, collected another 26 cents, $1.26 on the collection here. Then same day, the market just free fell out of bed. There is no harm in covering these when you get a massive sell-off, right? I'm taking profits. Well, and I was doing a webinar on this day, and I wanted to be able to say that here was the day that I lowered my overall cost basis to less than zero. So on this specific day, by doing these three trades, I lowered my overall cost basis on the stock to $4.59. Okay, so I own PIN for free because I only paid $4.49, right? And I've got a total collections of $5.49 at that given time. Now I sold these 190 calls against that again just recently. As you can see here, I haven't gotten out of those, but total collections of almost $6, folks, on a stock that I paid $4.49. And yes, I am doing these one-to-one for every 100 PIN stock I own, I'm selling one option contract against that. Now, if you own like you know, 1,000 contracts, 500 contracts, I don't mind you doing it as a ratio here. I like to do my covered calls full boat. If I get them all called away from me, I'm looking to sell some puts in order to buy that stock back. So I do this 1-to-1, trying to lower my overall cost basis, keep that math clean. But as you can see here, I own Penn when it's trading upwards of 114 or something like that as of today, for a cost basis of 0. And you know, you could look at it as Penn doesn't give me a dividend. Well, I've been collecting a dividend as well. If you like to look at it as like an income type strategy, this is a great way to do that. And absolutely, you folks can do this in a stock that has gone from $4 to $140 in 365 days. Staying mechanical, lowering overall cost basis. You can even do it with other stocks that I've showed. We even show, I think the last presenter was talking about synthetic longs, synthetic poor man's covered calls is what I like to call them. That's more of a diagonal where you're buying an in the money call, you get a poor man's covered call, you have limited risk to the downside as well. But with this is what most people will look at when they're looking at their portfolio. They've got a few stocks in there. I got involved in covered call strategies. Why? Because I was looking at IBM trading right around 100. It never went anywhere. And I was talking to a broker, and he was like, hey, why don't you just do some covered calls on this and get another dividend? And that's exactly what I did. I would sell it at around 110. I only think I got called away one time. Started selling some cash secured puts, bought the stock back, and just always sold covered calls against it when I would get a rip and get good strike location. Easy to do when you have a stock that's trading in a range like IBM. Amazon's doing that right now. It's not really going anywhere. Also, when you get these pullbacks where I see a market, you know, come off of those highs like what we've seen in this market, where you see these corrections. Oh, should I have bought? Should I have covered it? You know, should I have sold it? Should I? You know, people are always asking themselves, should I have sold that at 142, 149, whatever it is? No. Well, you sell the covered calls at those locations. Then when those markets start pulling back, you're kind of like, yeah, all right. You're not as worried about that pullback, losing money in your portfolio because the underlying selling off, because you got that covered call strategy. It's making you money. You look at, hey, I'll cover that covered call when I make money on it. And then that swing trade comes back into full swing and start moving to the upside. Look to sell some covered calls. Sell the rips, buy the dips is the best way to really stay mechanical with a trade like this on the covered call strategy. And finally, I want to talk about one other trade where you can even do this when you are working with a smaller account. And we talk about doing this with a poor man's covered call. What is that? It's basically we're buying an in the money call and we sell covered calls against it, rolling it out in time and staying mechanical. Now you can see on this one, I was doing the rolls. I wanted to do a little bit of a different strategy with this one to show how you could possibly just do it with a rolling covered call strategy, staying mechanical with that one trade in and out. And with something like Home Depot that's trading at a pretty tight range for the foreseeable future, could be an opportunity to implement something like this around these reopening trades that may not be working out as well. We've seen the sector rotation out of the reopening trade and into some tech, and then now out of tech into the reopening trade. Great time. We're seeing these rotations to do covered calls, lower your overall cost basis. I see a question. What happens when you get put back and drops way down? If the market rolls over rock and starts really selling off, you're going to continue to sell covered calls. You're going to have to kind of move with that pace, right? If you are doing this with a stock that is, you're trying to do this with a swing type trade, then obviously you're going to get out of that stock when it starts breaking below. For instance, for me and IBM, I would probably look to get out of IBM on my long stock if it started really breaking below 115. If I own stock here, I would probably only because that's where I've seen past support and resistance in IBM. If it broke much below 115, I'd probably look to cover that trade. But as you can see, rarely, only during that during the crisis did we really see that go below that. But I would probably pick out a line here and say, you know, if I was long, the stock starts breaking down, I'd cover that stock, all right, for a long term. But with something like this, if the stock gets called away, then you sell your cash secured puts down here, start selling calls against it again. And if the market rips off to the upside, right? If IBM gets called away from me and rips off to the upside, those are rich problems to have, folks. If it has, you bought it at 120, lowered your overall cost basis by $5, and then it gets called away from you, all right, $15 in that stock is a pretty good trade, all right, pretty good swing trade for sure. And as you can see, IBM does a, you know, you can swing trade IBM, it feels like all day long for the rest of the year because it's going to want to continue to make these current cycles. Do you aim for a specific monthly return on investment on the value you send? Okay, so for covered calls, good question, Juan. Covered calls, I'm looking to get that collection. It's going to get called away from me. I'm going to sell cash secured puts, stay mechanical with that. If I have a covered call strategy on around a specific underlying like IBM, you know, like the previous presenter was talking about, focus on what you know. Trade what you know is what we used to say. Trade what you know. And if you can focus on a few stocks that you know, boring stocks, have boring stocks like IBM in your portfolio and have some of your riskier stocks as well. I have no problem with that. That's diversification. On these stocks that are boring like IBM that, you know, most people would shy away from because they really don't go anywhere. They do pay a nice dividend. This is something great to do this in and around. So for a covered call strategy, as you can see, I'm usually looking to get out of these for around a nickel or a dime, right? So anytime it goes below that area, that's when I'm going to start looking to get a little bit more aggressive. I'm going to try and get out for that nickel or a dime. I want to cover it because to me, I've already squeezed out the best part of this trade, right? I don't want all the pulp that I have to like gnaw through for the last 10 days or something and work my butt off for that last dime. I'd rather cover it for a dime, be done with it, and then implement this strategy again. Now, I also have specific rules for other trading strategies, Juan, where yes, I do have specific price targets for a trade. For instance, like, a covered call, or sorry, a long call spread, I might be looking at 50% of max profit. All right. So I do have those kind of targets for you. And when, where, and why I would put on a long call spread, right? I don't pick option strategies out of a hat. We're not looking at a bullish assumption and saying you got to do a long call here. No, what we do is we look at the underlying internals and I drill down that to streamline your process and finding that. So great question. Another person is saying, I don't want to take cap gains on this. Something like maybe on Penn where you bought it at $4 is trading 142. Those cap gains like we're talking about could be quite dramatic, right? Well, then what you're going to do is you would offset the covered calls. You just buy those covered calls back in. Yes, you're going to have lost money on that covered call, but what it's going to do is it's going to just offset. Those covered calls are going to increase in value. And what we say is in the money calls have a benefit, right? So those in the money calls, the buyer has to have at least a premium that is equivalent to where the strike is to the underlying, all right? So if you get out of those in the money calls, all it does is erase the gains from where you sold the calls to where the underlying currently is. Does that make sense? So if I had sold 130 calls here and IBM trickles up and is trading 136 right here, okay, I'm short 120 calls. I don't want to take capital gains, which means that I have to pay taxes on my gains because it got called away from me. And now that's where I got out. Well, you would buy back in on the last day these 130 are, very close to the last day, maybe 5 days, because you don't want somebody coming in and, exercising their right. You don't want that capital gains. You don't want those calls to be, or your underlying called away from you. Then cover these. You'd cover them for probably $6 and, like 50 cents. You're going to have to pay a little bit more, right? You would have to pay $6.50 or something. All that does is erase, the difference between where you sold those calls and where it currently is. All right.
Hey, Eric, there's a question that came in here once, and the question is this: is there a sweet spot for covered calls and naked puts, such as near to 45 DTE?
Yeah, so covered calls, absolutely. And that's what I was trying to encourage people, is right around that 35 days to expiration for the covered call strategy. Or really, even if you're looking at a cash secured put strategy, which we'll talk about in different webinars, where to set that strategy up. But with that said, the covered call strategy, I'm looking at that 16 delta in the month. The spot month is what we used to call it on the floor. That's where the most time and volume is being spent. That's where everybody trades.
Sure.
It's at 35 days to expiration. And that's the sweet spot. Why? Not because everybody's trading there, but because theta, the thief, really starts coming into play and being aggressive with eroding those premiums through time. All right. Or time decay is what some people call it. We just called it thief. We want that thief to work out in our favor. And when you sell premium, that thief gets more aggressive. We can get out of this strategy quickly. We want to get in and out of trades fast so that we can, stay mechanical, move on with our lives. Just keep taking quick punches. I say I go for singles, doubles, and triples. We want to look for taking this, taking the wind out of the sails here and get in and out of this. So how do I pick that strike price? I'm just looking for the 16 delta.
Sure. And then there was a sort of like a follow-up question, which was, is there an ideal trade time to trade covered calls or naked puts? He was thinking maybe like Monday after monthly expiration occurrence. Do you have a thought about that?
I don't have a thought about that, to be honest. For me, I am looking for each specific underlying to try and catch a couple of big moves on the upside. All right. So if you start seeing it test a certain level, with my pin trade, I was looking for a couple of massive green bars to the upside because, I've been trading a long time. I know that if there's a couple of big bars, even like here in IBM, this is probably the time to start thinking about a covered call strategy. Anytime you get two massive big spikes, sell the rips, buy the dips is my thinking with the covered call strategy. I'm not thinking, the market starts selling off and I think, oh my God, I got to get mechanical with this and try and sell some covered calls because the market's selling off. I want to lower my call. That's the wrong time to start thinking about this. Covered call strategy is something, like I said, we are over time staying with this. It's a journey. We're going to continue to stay mechanical with this, keeping an eye on it. It's not just, on a specific day, I say, hey, you know what? Today is a good day to do a covered call strategy. No, that might very well be how you come up with it, but that would be the time to start. All right, picking your time. It's not always exactly that day. Now, maybe for instance, you got that day, you got a big candle like this, or you had the confirmation, on a chart pattern like that. That would be, I would say, hey, I would think I'm going to sell a covered call around that. So if we're lucky enough to walk in on it, something like that. But most of the time, what we're doing with this strategy is trying to keep our eyes out for opportunity. And when you get that opportunity on a big rip in the underlying, maybe it's testing a Fibonacci. And I talk about all those things in my daily market commentaries when I'm following along with this strategy, like I have with IBM. Then I'll talk about that. Hey, we've got this rip. It's up against, and as a matter of fact, I was talking about this trade today where, hey, we are up there at around that 130-ish level. I've got two Fibonacci's. I'm looking for an opportunity to sell covered calls in this IBM again. One thing I don't like to do is do a webinar, a video, and say, this is what I just did. I like to say, hey, this is what I'm going to do. So everybody has the opportunity to go out there and probably get this done before I do. But I don't like to say, hey, guys, this is a great trade. I think you should jump on board right now. And I had already done it. I don't
No, it
necessarily
doesn't
like
work.
the whole idea.
Well, Eric, we're coming up against the top of the hour here and was wondering, do you have a special offer that you'd like to share with everybody?
Absolutely. So, you like trading earnings, we have this particular course right here. And it's not just for this earnings cycle, right? You might say, hey, a lot of the earnings are already done. What we're doing here is we're setting up for the next earnings cycle as well and getting ourselves into high probability trades. So you'll be able to spot the best strategies for those specific moves in that underlying you're looking at. You come up with like a directional assumption and an underlying. And what I will do is show you how to go through a process in order to find the best strategy for that directional assumption. Because sometimes the premiums are going to be very expensive. I'm going to show you how to spot when premiums are expensive. We take advantage of that. And when premiums are super cheap. And it doesn't have to do with the VIX. We're going to be looking at that underlying and digging into the devil of those details. So, for $36, you're going to have about 10, 15 hours. And, if you're watching people on TV talk about option strategies around earnings, that's 36-cent option that they're talking about is going to be well worth you guys just flipping that over and taking this. And you get that through westmarktrading.com/Wilkinson for that deal there. And you're going to get all kinds of good stuff through that. So that's going to be our deal. Like I said, you can take advantage of that. It's earnings setups and how we trade a specific earnings in an underlying for that day.
That sounds great. And something I needed to share with you because I got just a kick out of it. Eric, when you were talking and you were talking about options, you got into floor trader mode. And I noticed that you were using hand signals. You were talking, I don't know, you need to have a course, a little mini bonus course, and what the heck you were doing there.
My kids make fun of me because every time a number comes out, it's like I'm doing 1, I'm 4. And, they're always making fun of me, like 3 sideways, 3 is an 8. So,
is that really? That's what that is? 3 sideways is an 8?
Yeah. So basically, it goes 1, 2, 3, and the reason why you do 3 is because 2 and 3s could kind of look weird across the way, or if you did
sure.
3. So basically 1, 2, 3, 4, 5, and then 6 is sideways 7. So it's 5 plus 2, 8,
sure.
9, 10, 20, 50, 60 is sideways on the head.
We've just signed up for the Wolfman gang sign then.
I think so.
I actually do have a couple of fun videos where I talk about like, Jan, Feb, March, April, May, July, August, Sep, Oct, Nov, Dec. So yeah.
I remember being in the pits and we were trying to learn how to trade. I'm like, oh, this is way too stressful. But
at first it does seem a little wanky, but after a while it just starts really flowing, and you don't even really realize how easy it is, and just the process of it all. It makes it where you could, on the floor of the board of trade, you could you could place a 747 jet on the floor of the board of trade. Well, think about that when you're looking across that room.
Right.
Somebody, they look like a little ant and they're going, sell me 100 at 2. So, those little nuances make a big difference.
Absolutely.
Well, thanks again.
Thank you guys very much for having me.
Oh, it was delightful. We always enjoy having you, Eric. Great job with the presentation. I appreciate the gang signs at the end there. I thought that was, but I just got a kick out of it. It's so natural for you to do that. And
old habits die hard.
Yeah, well, it's just part of your authenticity, folks.
I appreciate
So that was Eric Wilkinson, guys, with Pro Trader Strategies, and the special offer that he has, Wolfman's Options Course, the best strategies for trading earnings of your favorite stocks, how to find optimal strike location heading into the earnings season, and when, where, and why options are a best way to trade stocks. So you can use that special link, westmarktrading.com/Wilkinson. That'll take you right to that special offer. That's $36. That's a bargain, folks. That's a bargain. Anyway, hey, Eric, thank you so much, buddy.